Today, we are very pleased to welcome on Ben Spiegel of Redwood Capital Real Estate to talk about something before I connected with Ben that I was very unfamiliar with of even being a potential investment avenue, which is investing in RV destinations, luxury RV parks, because as real estate investors, we're always looking for kind of the next option and where to really kind of create value. And so many things have been so looked at and developed, such as single family real estate and everything else, that being able to find one of these niches to where value can be attained is very important. Myself, I'm Alex with Advanta. I've been here since about 2012. I have a lot of experience in doing all sorts of different alternative investments with clients. A little disclaimer before we do get started: Advanta IRA and our employees do not provide investment or legal advice. All information and materials are for educational purposes only, and all individuals are encouraged to consult with their attorneys, accountants, and other advisors before entering into any type of investment. Self-directed IRAs can certainly be used for any of these mechanisms we're going to be talking about today. A little bit about Advanta. Again, want to try to get through this and get to the meat of the presentation, but we've been in business for over 20 years. We offer dedicated client management for any of the accounts that we currently do hold, and we currently administer over $3 billion worth of assets under administration. If you would like a copy of the slides, feel free to reach out to me directly, Perny at AdvantaIRA.com. I can get you the slides. With the slight delay in this, I didn't have a chance to upload them as a handout to the presentation, so feel free to reach out to me directly. With that said, I'd like to turn it over to Ben so we can go ahead and get started. Please do remember that all of your audio has been muted on your end, so please do type into the chat box if you do have any questions.
Hi guys, so nice to meet you. Thanks for taking the time. My name is Ben Spiegel. I am the founder of Redwood Capital Real Estate. We focus exclusively on what I like to call special situations in the lower middle market. And what we define as lower middle market is usually transactions between 5 million and 35 million. We've found that that is the area with the greatest amount of inefficiencies. And that is what we specifically try to exploit to gain a quantifiable competitive advantage to be able to outperform the broader markets. So just a quick background before I get into the presentation. My background is in investment banking and private equity, distressed debt, bankruptcy, and restructuring. I moved over to real estate full-time in 2018. And how I really stumbled upon the RV asset class was I was doing more traditional real estate investments up in the Northeast. And even though I was doing well, I wanted to do better. And I knew from my former experience that to do better, you have to go towards something where there's more inefficiencies, that's either a niche or there's a stigma or it's out of favor. And that's what led me to the RV park asset class. I think that it represents one of the greater opportunities that we will see in the next 20 to 30 years in the asset class. So I'm excited to talk to you guys about it further. So I'll take it from here. So just starting off, we had, I guess, some technical difficulties in uploading, converting. So this is supposed to be trends and opportunities. So over the past 10, 15 years, there's been just a tremendous boom in the asset class. In 2021 alone, 600,000 new RVs were shipped, and 11.2 million households now own an RV. Just to put that in context, that's up 100% from 10 years ago. And if you look at the historic trend of new RVs sold over the past 10 years versus the actual outstanding pad count, which is really the place that they could park those RVs, it's about a 15x multiple. So pretty much the supply of RV pads versus the amount that were sold alone over the past 10 years is almost a 25x multiple. So there's 25 as many just RVs sold in the past 10 years than there are pads for them to park at. So that was one of the reasons I was very attracted to the industry, just given the humongous supply-demand imbalance. Also, due to the trends, you have economic factors, just that it's getting extremely expensive to take a vacation, to bring your 2 kids to Disneyland for a couple of days, flights. It's just getting unrealistic, and RV parks, or as RV destinations, I believe if they are built nice enough or renovated nice enough, offer a very legitimate, easy alternative. And also in the past 5 years, there's just been tremendous amounts of technology advancements, both in the RVs themselves and the RV parks, and with the additions of custom apps and property management software, and also major savings on the payroll and employer, just customers. The payroll side now, for example, 5 years ago, every call had to be fielded by an employee to take a new reservation, and now that can be done via a chatbot. So it's tremendous how much the efficiency is growing, and you're seeing the corresponding effects on the operating margins. And for investors' consideration, it is an extremely fragmented market. So 85% of all privately owned RV parks are owned by just single mom and pop operators that they usually live on site or close by, and they just own that one asset. And they don't really have the wherewithal or the capital available to make the necessary upgrades to keep pace with what new RV owners are starting to not only preference, but it's becoming more of a requirement. Also, big increase in income disclosures for RV buyers and just RV users. And there's been a lot of an increased desires for more extended stays, which obviously helps the investment from decreasing from a turnover perspective. 1 second. Yeah, perfect. So this is a very interesting slide, and I think it really kind of outlines how antiquated the industry is, and this is another reason I was really attracted to it. So 60% of all parks don't even have Wi-Fi today. It's pretty incredible. 73% don't have pools. In terms of just essentials, 82% don't have sewer hookups. 63% don't have showers. And 93% don't have any entertainment options. So it's very clear the current state of the industry has a lot of potential for improvement without having to implement just crazy amenities, just by adding Wi-Fi, keeping it clean, safe, and maybe adding a pickleball court will put you in a league so far above your competitors that not only will you be able to charge a premium rent per pad or an AD average daily rate, but your occupancy rate will be a lot higher as well. And something just to say is where I focus on buying RV parks, which is in the Southeast along the Gulf Coast, primarily in Mississippi and Alabama. Even the most undesirable RV parks are close to 100% occupancy. And I think that just goes to show you how it's a reflection of the supply-demand imbalance, that regardless of the quality, that they're still at 100% occupancy is pretty incredible. Really, what you have here is some statistics that previously mentioned, but also, so every year you have about 15,000 new RV pads are built, but around 400 plus thousand new RVs are sold. So every year it's only about 3% of just new RVs sold. That's not considering all the RVs on the just in place being used. Just every year, it's only about 3%. So that supply demand imbalance continues to compound year after year after year. The median age now, it's one crazy statistic is the median age of our new RV buyer today is 32 years old, and that's down from 49 in 2001. And really the spark that led this structural shift in society was COVID. It's now doing to digital nomadicism and as well as now 35% of all former permanent office workers are now permanently remote. It just provides a huge spike in the amount of interested people that would stay at a resort, especially if it was a quote unquote luxury. So basically, these are just some visual representations to show what I've been explaining previously. So 34% in just the past 3-4 years in the number of RVing households that own an RV versus prior, it's a 34% increase. And then basically the amount of people that actually own an RV from 2019 to 2022 was almost a 70% increase. That has never that kind of growth rate is pretty phenomenal. And the fact that the pad count growth rate is staying relatively stagnant, it's causing some very unique market environments, and I'll get into that later. Okay, so this just goes to what I was saying further. So I, coming from a private equity background, I do robust due diligence and analysis. So I probably drove from the Panhandle of Florida to New Orleans, and probably 100 times at this point, stopping at every RV park along the Gulf Coast. And what I determined was that Florida and Texas, even though this market is in its infancy, in my opinion, they were already somewhat saturated just due to the existing popularity of the state and just previous travel trends. But what I really noticed was that Alabama and Mississippi and Louisiana had a striking absence of institutional presence. And what I mean is almost nothing. And in this business, one of the most important things when you're starting out is to build economies of scale, to just reduce your overall cost basis and increase your margins. So I targeted very specific counties along the coastline in Mississippi and Alabama and Louisiana, where I made relationships with the mayors, with local developers that were large in the markets, and really put robust, what I like to call boots on the ground teams that not only are full-time sourcing me deals, but are able to assist in really any lawyers, engineers, everything that I could ever need to really make sure that I can successfully scale in these environments. And another interesting thing, if our usual strategy is to buy a value add, so buy a mom and pop owned operator park and restructure it via adding luxury amenities, fixing any deferred maintenance, putting the AI chatbot in, redoing the web. A big part of this business is also marketing, and that's really what the mom and pop operators are the worst at. They have little to no marketing, especially on social media. Their websites are lackluster, even if they even have one. And this, I'll get to this next, but 65–70% of RV destinations, they still do not take online reservations. If you want to stay there, you have to physically call them and hope they pick up the phone. And really a very simple statistic is when factoring in it, sometimes if you can get an attractive enough piece of land for a certain price, it sometimes will make sense to do select new developments. And in those cases, our cost to build has been on the high end. So this is what I do is I amortize the full development cost, the entire development cost over the price per pad. So that's everything from building the pool, infrastructure, everything, and what it comes out to between on the high end 45 to 55, and then once the park is stabilized and seasoned, we've found that depending on the location, we have been able to monetize at between 90 and 120 a pad. So it's not rocket science. If your cost is 45 to 55 and the market is 90 to 120, and the variables are just how do I get there, obviously there's a lot to it, but I tend to like simple numbers and simple facts like that. To me, it's the most important at the end, and it just makes it obvious that that there's tremendous opportunity in this industry, and it is almost impossible for accredited investors to gain access to a legitimate owner operator with a quantifiable track record to gain exposure to this asset class. And I'll just just finish off on this slide with a very unique thing about this industry that really no one's aware of is the U.S. Department of Agriculture has a very unique loan program that it's the Rural Business Loan Program. They say rural, but 99.5% of the country is considered rural to them. That they will provide an 80% loan to cost construction facility that's drawn over a 6 to 12 month period, because you have to remember there's very little vertical construction. You're only dredging, you're laying plumbing, and then you're pouring concrete. It's obviously a little bit more complicated than that, but that's really all you're doing. And the USDA will offer you an 80% loan to cost. So let's say your development budget and your land all in, you're at 10 million. They'll lend you $8 million at a below market interest rate that immediately upon completion of that construction, it turns into a 10-year permanent loan facility with an interest rate reset even lower. So this loan program enables groups like us to be able to build in areas where the land is really not worth enough for a normal private lender to feel comfortable, lending. Because let's say in that situation, 10 million, the land cost could have only been $1 million. So no normal lender is going to take that risk. So that's why having a very strong relationship established with the USDA is a very strong competitive advantage. And I'll just finish off with strategically, when the new map of what was considered rural and not from the USDA was released in January of this year, since then, we have strategically and opportunistically put under contract 10 different parcels that are eligible for this type of financing along the Gulf Coast or within 5 minutes from the beach. So to just guarantee that we have the opportunity to continue to deploy capital and target the rates of return that we're looking for. I just passed that one. That was supposed to be deleted. Okay, so when you're building if you choose to develop, or I guess in any situation, there's really 5 different types of RV destinations / parks. The oldest is a campground. They've been around for a long time. They don't have hookups. But the two, and it's not, they're left off the slides, but the two that I want to talk about that they've come into a lot of prominence and have gotten a lot more popular over the past 10 years is communities and resorts. Okay, so resorts are built next to Disneyland. They're built on the beach. They're built in a very high-end location where you have to build a lot of amenities, and your ADR, your average daily rate, is definitely going to be higher versus a community. But the only problem with a resort is your operating expenses are much higher, one, and number two, your turnover is much higher. So with a RV, with a resort versus a community, with a resort, your average stay is probably 2 to 4 days. And you have to have at least probably double the amount of staff working for you, and just more costs in general, because people, they're paying a higher rate, they want a higher rate of service. And so we have some resorts, but we like communities. So a community is probably could be located anywhere as long as it's close to major transportation, close to major highways. One important factor that I always like to consider when picking a site or a parcel is it needs to be within 10 minutes of a Walmart supercenter. I'm basically piggybacking on what I believe Walmart, which has one of the most advanced population growth analytics proprietary in the world. They're not building a supercenter in a place that's going to be declining to a population level that they need to close. So I always feel very confident that I have to be within 10 miles of a Walmart supercenter. And on top of that, I draw a 20, 30 mile line circle around the destination. And my real test is, I don't care what the quality of the RV park is in that circle area. They need to have a trailing 12-month operating or occupancy rate of at least 75% to prove to me that even that the demand is really there for more pads to be built. And so the communities, you have much longer stay time. So with our communities, our average stay is between probably 60 to 90 days and sometimes longer. So migrant workers or digital nomads that are IT consultants that are working and living full time out of their RV, and they want to stay in a place for 3 to 4 months at a time. You're charging by the month, you're definitely getting a discount, but on the other hand, you're operating at a 65% margin versus closer to 45 on the resort. The resort's more flashy, but in my opinion, the campgrounds are just more sustainable, attractive. Like, we're in contract to buy an RV park, our second in Theodore, Alabama, which is in Mobile County. Basically, there, I'd say in that it's 100 pads, winners, and we're going to be building another 80. At least 90% of the pads are occupied by full-time RV tenants that are there year-round, or at least there for a 9 to 12-month period at a time. They get billed by the month, but it's just a lot more of a recurring revenue business model. And instead of having 4 or 5 people have to work there, we only have 1 or 2. So and there's always the kind of hybrid strategy where you do a little bit of both, have a community and a resort built together, where if people want to stay longer, they can, but if people want to just come for a few days, that's fine as well. It's really what your strategy is, and it's really tied directly to location. Next slide. So in terms of if you choose to develop the right destination or a new destination, like I said before, even though this is an outdoor hospitality business, it is real estate. So the three most important things are location, location, location. Um, so basically sorry, these got deleted, but one second, just want to see if I can bring up mine. Sorry, and I'll send this to you guys after. So what it comes down to is, so the location determines the RV destination type. So, proximity, like I said, proximity to the attractions, highways, etc. And that, the destination type, whether it's a resort or community, determines what the RV customer is going to be in terms of what really, whether it's going to be more high-end spenders that really don't have specific price pressures versus those that do. And then the customer determines the amenities that are required, whether they're going to be very minimal or really robust. And to kind of give you guys an idea of how the range and amenities that you could have. So I'm building a new RV deeded condo lot development on the beach in Mississippi. I'm doing 140 pads, and this location, destination, it's definitely a resort, is going to not only have a gym with Pelotons in it, it's going to also have a spa, a yoga studio, and the pads, which are going to be sold as condos, are going to have options to upgrade by putting private hot tubs and pools in them. And there's a marina right across the way. They could buy a marina slit, and there's going to be a full-time concierge service. But to just kind of give you the economics on a deal like that, I think we're in a very kind of unique time period, like I was saying, because of the tremendous delta in the supply and demand ratio, that people that want to be on the beach are not able to reserve a rental pad on the beach. Even if they book a year in advance, it's not available. So we're getting to the point now where certain RVers or people that own RVs are willing to actually buy a deeded condo lot to be able to guarantee they are going to get that access when they want it. Even though they're only using it for 1 to 2 months out of the year, for the remaining months, they're allowed to rent it out, of course, exclusively through me, as a regular rental. And it's a 70-30 revenue split. The economics in this kind of condo development are pretty crazy. But however, it's a much more risky development, and I don't usually like to raise outside capital for anything that, where my strategy is to do, to build condos. At the same time, though, I will never build a destination unless my cost per pad is at a level that it's still feasibly economic, or if it makes economic sense, that to just operate it as a rental, as a backup option as well. So that really, that's the main indicator. That's fine. So just to kind of seeing the growth in luxury RV destinations, comes down to the location, the amenities, and what I really touched on before is the marketing strategies. No one really in this business, in the RV segment, knows what they're kind of doing in terms of marketing, and it is probably the most important thing. The website is the picture quality, the ability to have a chatbot make online reservations. It is, the marketing is, especially with like an RV condo development, it's everything. And especially when you're opening a new destination. Um, the only way to get the word out there is to have the same way you have a business plan for the RV park itself. You need an equal length marketing plan for the destination, because it comes down to even the signage outside the RV park, implementing ambassador programs where people, if they can, if they take a picture at the park and they upload it to the Instagram and they tag the park, they get $10 off their next month's stay. Working with influencers, very targeted niche advertising in certain publications like Garden and Gun, and just really getting it out there that your brand name is attractive and you can be trusted, that you, like a KOA, that you're going to be guaranteed to get a certain experience if you come to this destination. So yeah, just to talk about we can go to the next slide. Sorry. So this is really something that's pretty incredible in terms of the segments of revenue in the RV industry. Millennials make up 40% now. They're the largest segment by far, and that's why I can't emphasize enough. Millennials consider Wi-Fi not an amenity; it is a requirement. If you don't have Wi-Fi as a millennial, you're just not going to go there. And when the competitors could barely provide a place that is safe and clean and quiet, if you just build, like I said, a pickleball court and you have reliable Wi-Fi and maybe a small pool, and a good website, you're miles ahead of your competitors. Then you have Generation X, 28%, which is lower higher Gen Z, which is below millennials. They're very social media focused. And then baby boomers, they're really only contributing 15% of the overall industry revenue at this point, even though they make up a large percentage of the amount of RVs owned in terms of actual revenue to the industry. That's where they're at. Next. So basically, I apologize again for this slide, the slide deck getting a little getting a little messed up. I promise that Alex will send you the fully optimized presentation at the conclusion. So really also why the RV industry, there's opportunity, is because of the stigma. That there is a stigma around the RV industry that they are not desirable places to be. And that's why there's a huge NIMBY, not in my backyard. If you try to build one, the neighbors aren't happy. Nobody's happy. And it's funny because they'll make the claim that the people that are coming to your RV park are going to steal from my homes. And I reply, my customers are driving in on $1 million rig. I'm worried about you stealing their stuff. But that stigma, which is a big reason for the opportunity at all, it's out of favor and it's off the run. That's slowly starting to change. And really, what I attribute that to is post-COVID, there has been a structural shift in our society. It used to be for millennials that the ultimate goal was to get married, settle down, and put all of your savings into a house, dump all of it, and then you were at the place you want to be. That is no longer true. it has become a lot more accepted and popular for millennials to want to be able to have experiences and freedom over monetary items. And that it's not a cyclical shift in that it's going to reverse. I believe it's structural in that we're in a new norm. And that on top of being able to offer an upscale product is really makes this an attractive asset class. And one thing that is not pointed out here that I think is worth really mentioning is the rise in the RV sharing component of this business. Since COVID and even before, that this concept of RV sharing has taken a huge hold on the industry and is providing humongous tailwinds. So there's apps called like Outdoorsy, RV and Go, and a myriad of others, and they've grown in the past year and a half 700%. There are so many potential people out there that would never want to actually own an RV, but would love to rent one. And what that's doing is just completely augmenting the potential revenue base for your park. I would estimate that at any one time, at least 5 to 10%, if not more, of the RVs at a luxury RV destination are being rented. So it's a really phenomenal, and I'm more than happy to provide further information on that. But that's really a part. And if you're able to partner, it's confidential, but we're in talks with one of the major companies to enter into a partnership. Because based on my conversations with the company, the first question they get after they rent the RV is, where do we go? And to have them be able to recommend your resort chain is a huge positive. And in return, on your website, you put them as you rent an RV here, and it's very synergistic. So, like I was saying earlier, during my robust analysis of the Gulf Coast, that it comes back to the stigma that I mentioned before, that Florida and Texas already are quote unquote sexy, attractive tourist destinations. Before I got into this business, I never thought in a million years I would ever go to Mississippi or really Alabama for that point. But what I discovered is that everything is moving east from Texas and west from Florida. And there is only so much of beachfront on the Gulf Coast. And when we're in a situation where inflation like this and the housing prices and just prices of really everything are rising at expedited levels year after year, Mississippi and Alabama remain affordable options to get access to really the same beaches that Florida and Texas provide without the name recognition. And my thought process is that over the next 5 to 10 years, these two places are, we already see it now, just in terms of exponential growth and foreign, just an investment from outside investment, that these areas I think are going to explode. And I believe that they represent probably one of the best sub-markets. I'm talking specifically about the southernmost parts of these states, sub-markets in the country. So just in terms of institutional investors getting involved, you see some of the largest asset managers and private equity firms entering the industry in the last 18 months. What that tells you is they've done a ton of analysis and they believe that there is long-term opportunity in this asset class. And it's like you also have, for example, like I've been saying for years, that it's just a matter of time before the Marriotts and the Hiltons enter the outdoor hospitality business. And ironically, about 2 months ago, Marriott just, Hilton just announced that they were merging with AutoCamp, which is an outdoor hospitality provider, and to make their first break into the industry. So it was very nice to have my scenario, my hypothetical scenario, come to fruition after so many years, because it just they cannot afford not to have exposure to this asset class the way it's going to be growing the next 5 to 10 years. So in terms of potential opportunities and investments, so like I said before, the two strategies are very selective new developments or value add acquisitions, where you can buy a underutilized park from a mom and pop operator, acquire it, implement a proven restructuring business plan where you're adding amenities, restructuring the whole marketing and website, hiring new people, training them, and then usually you're able to do a cash out refinance, and then you can sell a couple years later. And we really, for our investors, over a 3 to 4 year time frame, target a 2 to 2.3x equity multiple for our limited partners, which translates to an average annual return of about 30%. So we feel pretty good about that. Basically, there's also a huge depreciation component. With accelerated depreciation, you're able to take 80% of most of the development costs in year one, and what that does is it can be applied to other investments, or it acts as a net operating loss carry forward. Let's say you got your pro rata share of the loss was 50,000. That will shield any future capital income, really helping on the tax front for your after-tax returns. Just the demand is rising. All right, next, Alex, if you don't mind. Talked about this already a bit. Just one thing I'd like to talk about is there's been a huge movement towards sustainability and just the whole green revolution. And what we're doing specifically is we are installing solar panels. We actually determine, there's a U.S. Department of Agriculture program where if there's these certain types of pergolas that you can put on top of the RVs, and according to the USDA, it meets the requirements for what's called a qualified mounting bracket. So the USDA will pay for 100% of the installation of the solar panel if you put them on these types of pergolas. And that does two, one, it also along with EV chargers, and any park that we buy, we immediately upgrade the pads to be able to charge electric run RVs in the future, because that's going to be seeing, and in addition to just EV chargers, at one place within the destination, because an RV, a fifth wheel owner, which is the type of RV that's trailed behind a car, are 4 times more likely to have an electric vehicle or hybrid vehicle than someone that doesn't own an RV. So in terms of a SWOT analysis quickly, growing popularity, technological integration on the opportunity sides, there's collaborations. Just to mention, we're working with an RV self-storage company to be able to provide valet service to certain of our customers that are snowbirds, and they're down for the winter, and then they're gone during the summer, and they don't want to drive their RV, they don't want to pull it both ways, and then it's aesthetically unpleasing in the driveway. So they'll happily pay you a couple $100 a month to store it for them, and then we will drive it to the pad and make sure it's fully cleaned and installed before they get there, making it very easy for them. In terms of the weakness side, the business is seasonal. You're operating between around an 80% occupancy during the summer months and closer to 40 to 50% during the winter months. So you have to, that's another thing about the business. You just have to be well versed in cash flow management, liquidity management, and how to implement marketing strategies to really try to get that through dynamic pricing to get that winter occupancy up. And obviously, economic downturn, regulatory challenges, zoning is a huge issue. That's one of the biggest barriers to entry. In terms of competitive pressures, obviously, the few publicly traded REITs have a large competitive advantage due to their economies of scale and ability to borrow at abnormally low rates on an interest rate basis. Next, Alex, if you don't mind. So in terms of risk mitigation, just pick a good location, make sure you're compliant, really make sure you have Wi-Fi. And what I can't really stress enough is how much of the human interaction and the actual management plays a part in this business. If you have bad reviews, it is very hard to come back from that. So you need to make sure that your customers are satisfied. And one of the biggest challenges in this industry is hiring and retaining the human capital for the price that you can afford that's necessary to actually implement the level of service that you want, or that the renters want to feel comfortable. Yep, so just to get back to some statistics and to conclude, really, just about every year, over 400,000 new RVs are sold, yet between 12 and 15,000 new pads are built. So, I mean, so you just do over the past 5 years, that's around 2 million new RVs versus just around under 100,000 of new RV pads. So it is phenomenal. It's a 20x. And the average RV buyer in the United States now is down to 33 years old. And the average RV destination is 40 years old and have not received a dollar in investment upgrades or amenity upgrades, which is a big part of the opportunity set. And I thank you so much for listening. I'm open to taking questions, and Alex, I'll let you take it from here.
Yeah, no, again, thank you very much. And certainly do have some questions on here. Wanted to make sure we held those to the end, so that way, anyone that had a little bit of a tight timeline with this, and we will certainly be happy to email out the slides. What I'm going to do real quick is just send out to everyone my email address. ADV IRA. So if you would like a copy of the slides, feel free to email me. I can shoot those out once we get everything updated and correctly formatted. But let's see. So someone made the statement of sales risk pads doesn't seem to represent true demand imbalance, as some people only use their RVs twice a year. How do you kind of weigh that with, the kind of casual use of RVs that we've seen so much over the course of history versus kind of what you're trying to accomplish with, occupancy typically being what is used to gauge demand?
Yep. So usually demand, how you gauge it by really looking at occupancy rates and changes in occupancy rates. So over the past 7 years, the average occupancy, and this, but mind you that RV parks are a lot more attractive of an investment in a favorable climate. So obviously, I would never buy an RV destination where it snows, where there's a harsh winter. I specifically stay in the South to try to minimize seasonality as much as possible. But over the past 10 years, on a nationwide basis, average occupancy has increased from about 48% to about 67%, and that's countrywide. You are right with the comparison that most people do not use their RVs most of the year. However, like I mentioned, the RV sharing apps have dramatically changed that, in that maybe they're not using them a lot of the times, but over 50% of RV owners have now chosen to explore renting them out via the share platforms. And so I don't know the exact statistic, but that is making up probably half of the balance in what we were talking about before. But I'm more than happy to have, if you want to just email me offline and have a much more in-depth conversation about it.
Yeah, absolutely. And someone else asked, the states that you mentioned, such as Mississippi, Florida, Alabama, in the Southeast, have, right now we're in the middle of it, hurricane season, and also tornadoes and things like that. So are there any different types of mitigation factors or things that you look for when doing that? Or is it just kind of the costs and it's part of the risk analysis of dealing, you might have seasonality in Maine, but you have, natural disaster season down in the South. So how does that kind of play into your strategy?
Yeah, absolutely. So everything, I view every deal as a special situation. You have to approach every deal differently. So like, for example, the luxury RV condo development, I'm building on the beach in Long Beach, Mississippi. Somehow, even though so it's the beach, and then there's the road, and then my parcel, and there's a steep hill, and it's actually located, it's 22 feet above sea level. I had looked at a couple of other parcels in the area that were also on the beach, but they were either below sea level or only 5 feet above sea level. And in terms of risk mitigation, we are going to be installing a couple foot barrier wall. And on top of that, you either certain materials, and then you have what's called runoff ponds, where the drains lead to. There's a couple bodies of water on the actual RV park site itself for extra drainage. And then you always have to have, and in terms of the physical structures, you obviously elevate them at least another 4 to 6 feet above the ground level, and you make sure that there's at least one facility that's built strong enough to really withstand a storm of any caliber. But the thing though is that if people are staying at an RV resort that is in a hurricane path, they are required to leave. The state issues mandatory evacuation notices, and they have to leave. And if they do stay, that's their prerogative. I mean, you're not liable, but insurance will not pay for any of their damages. The key number is 22 feet above sea level, because that's where insurance will actually cover if you try to stay. So, I mean, between the runoff ponds and then using certain materials that absorb water, and even some sun pumps, you really, whether you're right on the beach or, I mean, like if you're in Mobile, but you're like 50 miles from the beach, you get stuck with these storms. You're hoping you can make it a campground policy that, anytime a storm of, X caliber is projected to hit, that, you're required to leave. And you put that in the signing docs, and, basically they sign it, and, they are not, you could choose whether to refund them their money or not, but there are a lot of strategies you can put in place. And I want to be really upfront with everyone here that I am not building or buying these to give them to my grandkids. I am looking to exploit a opportunistic window in the next 3 to 5 years where I can buy these parks for 40,000 a pad, put on average 5,000 a pad into them, and sell for 80, 90,000 a pad a couple of years later. I'm not looking to hold these any longer than a maximum of 5 years. And that goes back to the natural disaster component. Is I don't want to be around here too long for things to get worse and worse. And the one thing you have going for you that's pretty good in those areas is most people do not actually even believe in climate change, and that the water, that the sea levels are rising. Not that, so I'm not saying that that's who your buyer is going to be, but I mean, for these RV the condo development I thought it was going to be much more of an issue than it actually was. The fact that I've completed 15% of the pads, I've already pre-sold them. But yes, that's definitely top of mind. And I'm actually utterly surprised with developer colleagues of mine that are doing developments like in Biloxi on the beach that are in excess of 500 million, and nowhere in the presentation is a mention of environmental risk. So I think it's something that is definitely not focused on enough, and it's something that I've paid consultants for every site we have to give me weather change reports and flood reports and the probabilities of whether this site would flood, or what could happen to it. And that's one of the due diligence processes that we implement before even closing on an existing RV park or a piece of land. So I like to say we assess it to the best level we can.
Yeah, and two last things to end up on. But you wouldn't mind plugging out your contact information real quick?
Yeah, in the chat.
Yeah, if you could put it in the chat, that would be
that's fine.
Be great. And the last question pertaining to what's the most common exit strategy for this that you implement? Is it cash out refis? Is it just a straight sale?
So
maybe just
yeah, exactly. So usually the plan of action is to acquire existing, you restructure and stabilize and do something called season the cash flow. Banks like to see a trailing 6 or 12-month period of consistent cash flows at the level that they're currently at. So usually at the 18-month mark, latest the 24-month mark, we're doing a cash out refinance. And then about 6 or 12 months later, especially because I haven't even mentioned this, is that anything you buy now is a big interest arbitrage play. That as interest rates go lower, the asset you own is going to be worth more, because when you acquire it, you're paying a 7% interest rate, but the future acquirer is going to be paying 5.5%. So you'll have what's called cap rate compression, and it adds a significant amount of value to the site in terms of exit. And then about at the 3-year level or 3-year level at the 3-year mark, look to sell. And like by the way, I don't buy anything that is publicly marketed. If it is on the internet or it's sent to me in an email blast that goes to other people, I won't spend 10 seconds on it. I exclusively buy off market, either through a pocket listing, which is when a broker where I have an amazing relationship finds a deal and the owner just wants to close quickly and wants something called guarantee of close, and I'll be able to get it. I need to be able to buy the park at least a 10 to 20% discount to what it would go for if, say, for example, Marcus and Millichap was marketing it, because your cost basis is everything. And then I also do seller direct, straight to the owner themselves. And a lot of times what you're able to do is you're able to get seller financing, which is really when the seller of the RV park is willing to hold a considerable amount of the debt in a note that is, so it really, especially for the RV parks that they're really not in the best place, and that a normal lending institution would not touch it, they have to provide seller financing, and usually they're willing to go up to 80, even high as 90%, for a 3-4 year period. So what you say, you're buying a 5 million RV park, you're only putting down 500, and they're taking a $4.5 million note, say, and the full raise is $1 million because you need the 500 for value add renovations. You're into just the higher the leverage, the higher the returns, as long as it's responsible and you have robust, debt service coverage ratio. But it makes it a lot easier to close. Also, with seller financing, you can close in as little as 30 days. And we have relationships with all the top consultants in the industry for everything from engineer, design, feasibility, optimization, operational optimization. And we're actually about to go into contract to buy it would probably be considered the largest off-market RV portfolio sale that's occurred in the Southeast ever. It's going to be about 750 pads in total for around just under 50 million. And there's 6 destinations between southern Alabama and Milton and Pensacola, Florida. And it's a very unique situation because it's a forced seller, and has to sell for a very uneconomically motivated reason. And so he just needs to get rid of them, and he's time motivated. So I've been able to lock in a $40,000 a pad price, which is an in-place cap rate of close to 8.5%, 9%. With once it's stabilized, I have it at over 11 to 12. And also he's a phenomenal manager. So he's going to be rolling equity into this new acquisition from his existing holding, and he's going to be he's a phenomenal operator. So he's going to continue to manage them and have a equity option plan. That's another, coming from the private equity background. Nobody in the real estate business really understands, or in my opinion, comprehends the importance of the property manager and what happens on site. To me, that is everything. Asset management is important, but the guy making the day-to-day decisions on the site is vital to the success of the project. A good property manager could turn around a bad property, and a bad property manager can ruin a good one. So unlike most real estate owners that like to just really beat up on their property managers and pay them the minimum amount, I like to structure creative agreements where they are highly incentivized to increase not only the revenue, but the profitability of the RV park itself. And over my experience, I've found that any incremental money paid to the property manager has resulted in a 10x or more multiple return on added value on a sale.
Great, awesome. And there's been a few questions in here peppered in regarding like the investment structures and rates of return and things like that. I would encourage you to reach out to Ben specifically. We like to keep kind of investment return specific stuff, out of the realm of the webinars, just because these are educational purposes only, and they do, kind of live in perpetuity on our YouTube as well. So with regards to things like that, I'd encourage you to reach out to Ben directly. I'm sure he'd be happy to kind of discuss more of that granular aspect of investments they might have going on directly with you. And just two quick questions, if you wouldn't mind, just so we can make sure we do get people's stuff addressed, since it was a little bit of a late start. Could you just briefly touch on how the value of RV parks kind of are determined? And then the last question is regarding expansion. Like, how do you kind of, figure out the expansion? And just make sure you do, maybe to start that off, give out your contact information, because I don't think it went through in the chat.
I put it in the, oh, it's to organizers only. So, organizers only, or organizers and panelists?
No, you would just, if you want, just read it off and I'll send it out to all here.
Do you not see the chat that I sent you?
Well, it only came to me, but if you just speak it out to the people,
Yeah.
I can also send it out in the chat.
Okay, yeah, so it's B Spiegel, B, S, P as in Peter, I, E, G as in girl, E, L, at Redwood, R-E-D, W-O-O-D, capital, C-A-P-I-T-A-L, and then advisors.com. I apologize for the length of the email in advance.
All right. Yep, that has been sent to everyone as well. So yeah, just how you determine value on these real quick, and then also with regard to expansion.
Yeah. So the first on value is it depends a lot on the quantity of pads that are being sold or bought. Obviously, the more RV pads, the higher the premium. Usually for an institution to make an investment, it needs to be at least 200 to 300 pads. But so in terms of valuate, you need an above average cap rate. The way I do it is I model out on a pro forma basis, how much revenue and NOI, per pad could a park do, and then apply a certain multiple to that based on the area. I'd say a good number to use, it's completely dependent on the location. I mean, the most, I guess, universal way is always cap rate, and in place cap rate at acquisition, and versus the pro forma cap rate upon stabilization and restructuring. And just generally, I am usually between 35 and 45, maybe 50,000 a pad. Some like these ones I'm buying in Florida, they're generating on average $2,000 a month, versus some in Alabama that are generating $575 a month. So obviously for those I'm paying upwards of 60, but I would really just focus on the not only NOI, but focusing on your after-tax cash flows, and basically assigning a pro forma cap rate on exit to based on what the future optimized NOI could be. And I would put that at roughly 100 basis points lower than what you purchased it at.
All right, great. Well, again, I do appreciate your time being on here today. To everyone here, I do thank you for sticking with us on the technical difficulties we had. If you would like some more information, I do encourage you to reach out to Ben directly. I'm sure he'd be happy to connect with you individually. I did send out the email in the chat, so you can just email him, set up a consultation if you'd like to learn more about the topic at hand. Once we get these slides organized in a better format, I will certainly be happy to email those out to anyone that would like them. I did also put my email in the chat, so if you would like that, I'll make sure I send the slides to Ben as well, so he can provide them to anyone as well. Again, really do appreciate everyone being on with us today. It was great having Ben on. We also did a podcast as well on this topic, so if you'd like to learn more, again, you can check out the recording that we're going to have on YouTube, or as well, you can also check out the podcast that we did, which I believe is live currently. So again, if you do have any questions, make sure you reach out to either of us. Again, thank you so much for being on with us today, Ben. Do appreciate your time. Okay, with that said, we will go ahead and end it off. Have a great day.